Like an ocean, the stock market can seem a deceptively calm place until a storm blows in suddenly and tosses portfolios around like so many toy boats. It happened in October 2008, and it happened again this month. Bill Ferrell says it's going to happen again, so don't be surprised. Plan for it. Bill is CEO of Ferrell Capital Management, which runs the Concert Fund, a low volatility fund of hedge funds. Bill is here to explain to us what volatility is all about, how to plan for it, how to predict it to a degree that you can. Bill, let's start with this. Are markets becoming more unpredictable?
Well, if there's one thing we've learned from the recession and recent volatility, it's that portfolios need much better risk management. Now, having said that, the good news is that transparency is becoming the mode of the day. And has increased dramatically since 2 years ago. Even hedge funds, the most secretive part of the money management business, have become more transparent. And the second thing is that risk measurement tools are much more precise than they used to be.
Let's pull up a chart, though. 5-year chart of the VIX. This is the implied volatility index. It shows people, it's an indication of what people are prepared to pay for protection against sudden losses in the equity market. The big spike back there was in 2008, but you can see on the very right-hand side of the chart, we had a harrowing experience with the VIX just over the past week. It shot up to 45, not quite the 90 levels that we saw back in 2008. But what is that telling us? If you're an investor, you're looking at the VIX, they call it the gauge of fear. Why is it so important?
Well, the VIX is a forward-looking option-based contract. It's basically an index of what people are requiring to write options. What happened with the VIX recently is interesting because the last time it reached the peaks, it was a mirror image of 1998 when the euro was being formed. Russia defaulted, and long-term capital management was unwound. And a lot of the unwinding was getting rid of the yield curve convergence trades that were being done back then. Now we got a situation where the VIX spiked at the end of April. The smart thing to do would be to pay attention to that and use other risk metrics to determine whether or not you wanted to put hedges on. And in fact, they did indicate that you needed to put some hedges on for May.
Okay, so let's talk a bit about hedging, why it's important. Long-term investors, if they're invested, they can just kind of wait and let it ride out. But for pension funds and endowments, the kinds of people who you manage money for, they're taking money out of the market all the time. So why for them is it so critical to hedge?
Let's put things in context here. A chief investment officer uses the best information available to him at the time that he constructs a portfolio. And that portfolio is constructed with the idea of having a target return and a bandwidth of what that return range could be. The problem is that market volatilities and covariances change a lot faster than asset allocations. So when a portfolio is constructed based on the information used as the input, over time, those portfolios can be wrecked by changes in covariance and changes in volatility. That's where we come in to hedge risk to maintain the range of outcome that's prescribed in the first place.
Now let's talk about, you mentioned right off the bat that hedge funds are giving you more transparency. That's a pretty compelling idea. Hedge funds aren't known for transparency. They tend to keep things pretty close to the vest. How is it that all of a sudden these guys are opening the kimono?
They're opening the kimono because they have to. There were probably a few dozen hedge funds 2 years ago that provided transparency. My guess is that there's somewhere between 1,500 and 1,600 now that are offering transparency to the risk measurement companies. And they're finding that they can do that without giving up too much, but make it possible for investors to keep their investments with them.
Does it make it easier to manage risk?
It makes it a lot easier to manage risk.
So ultimately, in one way or another, the hedge funds, whom we blame for so many things in the market, are actually helping us, although they're being prodded to help us, in making it an easier place to navigate.
They're being prodded. They've always been reasonably good risk managers. They're now opening it up so other people can use their information.
Bill, thanks for joining us. Bill Ferrell, CEO of Ferrell Capital Management.